Energy, best performing sector this year, up 50%. So, Bryn, I'm turning to you for obvious reasons. And the reason I bring this up today is because they've come after every sector. Staples, the defensive trade was working so well until they hammered it last week. Now some wonder whether energy is the next and last sector to get hit. Jonathan Krinsky, while we respect relative strength, it's unlikely this bear market concludes without a meaningful shakeout in energy. Now, I know why the energy trade continues to work, and I think most people do too. There are many other factors involved in why that trade has been what it has. But what about now, and what about that view?
Yeah, I mean, energy's been walking tall all year long. I think that Jonathan makes a good point that it's 30% above its 200-day moving average, which you haven't seen, I think, in 2 decades. But what I would say is that we haven't been in this environment in the last 2 decades. And I still go back and say, energy a year and a half ago was about 2.8% of the S&P. Right now, it's about 4.8% of the S&P. What's also interesting, Scott, is that this year, energy will contribute $18 to the S&P's bottom line. So the S&P does $226. Energy will contribute 18 of those dollars, so close to 18%, although it's less than a 5% sector. And so I think the earnings are real there, and so the returns are justified. But I do see that people are still very skeptical of energy. It's had a wonderful 2-year return, but energy relative to the S&P, it's still really cheap. So, I mean, I like energy. I think I'm gonna stay in the space. But I do hear what he's saying, what other people are saying, is that it has a nice run. But you do get great dividends. Even if you didn't get much capital appreciation, something like a Devon is still paying you an 8% dividend. I'll take that all day long, even if Devon does nothing.
What do you think?
I think it's due for a short-term pullback. But I think the reason it hasn't, Scott, is people are using this as a hedge for what goes on with Ukraine. I think it's just that simple. I think if people say it gets worse there, they want to have some energy exposure just in case oil goes to $200 a barrel. That said, I think it's due for a pullback. I have to agree with Jonathan on this.
Surat, you own Chevron, among others. Chevron today got downgraded at SocGen, but you've got Apache. I think it's Apache. Chevron, EOG, Pioneer. You've got some pretty good exposure.
Yeah, and I've been actually, I mean, I agree with Bryn. I think, you want to be here, but I would take profits on some of the speculative, the Apaches of the world, take some off the top. Those things have had a great run. And really what you're holding off here, Scott, to your point, is if the market's sniffing recession, it doesn't really matter what happens then. Oil's going to come down just because it's going to be demand destruction. And even if you're hedged against what's going on in the rest of the world, that services side of our economy is going to slow down. People are going to be driving. Trucks are going to be on the road. That's going to hurt. So, when some of these stocks have done so well, like the Apaches of the world, no question it takes them off. But I do like my large integrateds. I want exposure there because I do think the secular demand for energy is still going to be there, even though 2 years ago everybody was talking, get out, get out, get out. I think you want to be in part of this market.
Okay.